You think you're doing everything right with your money. You're saving. You're being careful. You gave up the daily Starbucks run. You're steering clear of anything that feels risky. And yet, your bank account still feels stuck, your portfolio is barely moving, and you're watching other people seem to build wealth in real time while you're just treading water, wondering what you're missing. Here's the uncomfortable truth nobody wants to say out loud. The problem might not be that you're not trying hard enough. The problem might be that some of the habits you think are smart, the ones that feel responsible and cautious and sensible, are actually the very things holding you back. Today I'm breaking down 12 investing habits that feel completely reasonable on the surface but are quietly keeping you broke, and by the end of this video, you'll know exactly what to swap them out for. So let's get into it. First up, waiting for the perfect time to invest, and this is the #1 wealth killer for everyday Americans because it's disguised as patience. You tell yourself you'll start investing when the market dips a little more, when interest rates come down, when inflation cools off, when things feel more stable. But here's what actually happens. The market goes up, you wait for a correction, the correction comes, you panic and decide to wait until things settle, and then you wait again. Research on the S&P 500 consistently shows that missing just the 10 best trading days in any given decade can cut your long-term returns in half or more. And the brutal irony is that those best days almost always happen in the immediate aftermath of the worst ones, when the majority of people are too scared to be in the market at all. The fix isn't complicated. Start now, even $50 a month, automate the contribution so it happens without you having to make a decision every single time, turn off the financial news in the morning, and internalize this one truth. Time in the market will always beat timing the market, always, and every year you wait is a year of compounding you can never get back. Second, keeping all your money in a high-yield savings account and calling it investing, because right now a HYSA giving you 4.5% or even 5% feels like a genuinely smart move, and for your emergency fund and short-term goals it absolutely is, but if your entire financial strategy is a savings account, you are not building wealth. You are slightly slowing down the rate at which inflation erodes your purchasing power. Interest rates move. The Fed cuts rates, your yield drops from 5% to 3.5% to 2%, and suddenly that safe return isn't even keeping pace with inflation anymore. HYSAs have a specific, valuable role in a healthy financial plan, and that role is not replace your investment portfolio. Keep 3 to 6 months of expenses there, keep your short-term savings there, and put everything else to work in the market. Third, buying individual stocks based on Reddit threads, YouTube comments, or your coworker who made 40% last year. And I get it, because when someone in your circle hits big on a trade it genuinely feels like you're leaving easy money on the table, but what you never see is the 10 other people who quietly lost a significant chunk of their savings on the exact same bet and never brought it up at lunch. Individual stock picking, even for professionals with research teams and Bloomberg terminals and decades of experience, consistently underperforms low-cost index funds over long time horizons. That is not an opinion, that is decades of documented data. And if you want real market exposure without gambling on single companies, broad index funds and ETFs are the move. Low fees, diversified across hundreds or thousands of companies, boring, and genuinely effective at building long-term wealth. The exciting trades make for great stories, and the boring index funds make for great retirements. Hunting for the best savings account interest rate while completely ignoring your actual investment strategy, because you spend an entire weekend comparing rates across 6 different online banks to capture an extra 0.15% in interest and you earn maybe $30 extra over the course of a year, while simultaneously you haven't spent a single focused hour reviewing your 401k contribution rate, understanding your asset allocation, evaluating the expense ratios on your funds, or learning about tax loss harvesting, strategies that could realistically put thousands of extra dollars in your pocket every single year. Your time and attention are your most valuable financial resources, and spending them on micro-optimizations that barely register while neglecting decisions that actually move the needle is a trap that feels like diligence but functions like avoidance. So direct your energy toward what matters at scale. Fifth, investing only when you remember to or feel motivated, because some months you transfer money into your brokerage account, other months something comes up, a weekend trip, a flash sale, a dinner out, and you skip it. And this kind of inconsistency is one of the quietest wealth destroyers that exists because it never feels like a catastrophic mistake in the moment. The solution is automation. Set up automatic contributions to your 401k, your Roth IRA, your brokerage, whatever accounts fit your situation, and pay yourself first before your brain has a chance to find a reason not to. What you don't see sitting in checking, you won't spend on things you don't need, and discipline built into a system will beat willpower every single time because willpower is a finite resource and a scheduled transfer is not. Sixth, avoiding financial education because it feels too complicated or too overwhelming, because terms like expense ratios, asset allocation, tax-advantaged accounts, and rebalancing sound intimidating, so instead of sitting down and learning, you do nothing, and here is the real cost of that choice. Financial illiteracy is not free. Every year you don't understand how money works, someone else benefits from your confusion, banks charging unnecessary fees you didn't know to negotiate, fund managers with 1.5% expense ratios quietly eating your returns compounded over decades, insurance agents selling you products you don't actually need packaged as things you can't live without. You don't need a finance degree. You need to understand the basics, how index funds work, what a Roth IRA actually is and why it matters, why expense ratios are so critical over long periods, and how compound interest builds real wealth over time. One focused hour per week of genuine financial education will do more for your future than almost any other single habit you could build, and there has never been a moment in history when that education was more accessible or more free. Seventh, skipping health insurance or choosing the absolute cheapest plan without understanding what it actually covers. And this is the single habit that can wipe out years of careful wealth building overnight because people skip adequate health coverage to save $200 or $300 a month on premiums, and then one emergency room visit, one surgery, one unexpected diagnosis hits and they're suddenly staring at a bill for $20, $50, or $100,000. In America, medical debt is one of the leading causes of personal bankruptcy, and that reality does not discriminate based on how disciplined you've been with your investments. Health insurance is not an expense in the traditional sense, it is the protective wall around every other financial goal you have, and you should not treat it as optional, and you should absolutely not choose a plan based solely on the lowest monthly premium without fully understanding your deductible, your out-of-pocket maximum, and what your network actually covers before you need it. Eighth, ignoring life insurance if people depend on your income, because if you have a spouse, children, aging parents, or anyone who relies on what you earn and you don't have term life insurance, you have a massive and dangerous gap in your financial plan that you are one tragedy away from discovering. Term life insurance is one of the most affordable financial tools available to the average American. A healthy 30-year-old can often secure $1 million in coverage for $20 to $30 a month, which is less than most people spend on streaming subscriptions, and yet millions of Americans skip it entirely, leaving their families financially exposed in the worst possible moment. Get it while you're young and healthy because the longer you wait, the more expensive it becomes, and the harder it gets to qualify for the coverage your family actually needs. Ninth, carrying high-interest credit card debt while simultaneously trying to invest. And this one trips people up constantly because it feels like you're doing two responsible things at once when in reality the math is working directly against you. You're contributing to your brokerage account while carrying a balance on a credit card charging 24% or 27% annual interest, and even if your investments return 10% per year, which is a solid long-term historical average for the S&P 500, you are losing money in net terms because that credit card is costing you more than double your gains simultaneously. High-interest consumer debt is anti-wealth. It works against everything you are trying to build, every single month, so the right sequence is this. Always capture your employer's 401k match first because that is an immediate 50% to 100% return on your money and nothing beats it, but after that, eliminate high-interest debt aggressively before you build the broader investment portfolio, because paying off a 24% credit card is guaranteed 24% return that no index fund can reliably match. 10th, holding too much cash because the market feels scary or uncertain, and yes, you absolutely need an emergency fund. 3 to 6 months of living expenses in a liquid, accessible account, that part is non-negotiable and genuinely important. But beyond that, holding excess cash just in case or because you're waiting for the right moment is one of the most expensive forms of financial anxiety there is. If you have 2 or 3 years of expenses sitting in a savings account because you're afraid of what the market might do next quarter, you are paying an enormous opportunity cost that is invisible but very real. The S&P 500 has historically returned around 10% annually over the long term, and every year that extra cash sits idle you are leaving that return on the table while inflation simultaneously chips away at what you have. Real financial security does not come from an ever larger pile of idle cash, It comes from growing assets that outpace inflation and compound over decades. 11th, avoiding the stock market altogether because you're afraid to lose money. And I hear this constantly: what if the market crashes and I lose everything? And I understand the fear. It is real, it is human, and it is completely understandable. But here is the context that changes everything. Markets do crash. They crashed in 2000, in 2008, in 2020, and they will crash again in the future. But here is what happened every single time without exception. The market recovered, and over a long enough time horizon, went significantly higher than it was before the crash. A diversified portfolio of broad index funds held for 15 to 20 years has historically never produced a negative return, but failing to invest in equities at all almost guarantees you will not have enough saved for retirement. The real risk most people are ignoring while they obsess over short-term volatility is the slow, certain, invisible erosion of their purchasing power through inflation and missed compounding. That is the risk that quietly guarantees a financially stressed retirement, and it gets zero attention because it doesn't feel dramatic. And 12th, stopping your investments the moment the market goes red, because the market drops 20%, your portfolio balance looks terrifying, panic kicks in, you pause your automatic contributions, move to cash, and tell yourself you'll get back in once things stabilize. And this single mistake is the most common and most devastating thing retail investors do to their own long-term wealth. Market downturns are not a warning signal to exit. They are a discount on every single share you buy going forward. Every contribution you make during a downturn is made at a lower price, and when the market recovers, as it always has, throughout every crash in modern history, those discounted shares generate outsized returns that the people who fled to cash never capture. Stopping your investments during a market correction is like walking out of a store the moment a sale begins because you're worried prices might drop even further. Stay consistent. Stay in. Keep the automatic contributions running. The wealth is built in the boring, uncomfortable, I'm going to keep going anyway moments, not in the exciting ones, not in the confident ones, but in the disciplined ones. Here's what ties all 12 of these habits together. They all feel smart, safe, or cautious in the short term, but every single one of them fails to account for the full picture of long-term wealth building. Real financial growth isn't about avoiding every possible loss today. It's about building assets that grow and protect your purchasing power for decades. The question you need to stop asking is, what could I lose? And start asking instead is, what am I giving up by not acting? Because every dollar sitting idle has an opportunity cost. Every habit that keeps you from learning, automating, protecting, and consistently investing is a habit that keeps you financially stuck. No matter how responsible it feels on the surface, no matter how logical it seems in the moment. So here's what I want you to do right now. Take this list of 12 habits, identify the one that hits closest to home, and make one concrete change this week. Not next month, not when things feel more stable, not when you feel more ready. This week, one change. Small moves made consistently over years are what separate people who build real wealth from people who always feel like they're almost there but never quite get ahead. If this video helped you think about money differently, hit that thumbs up. It genuinely helps this channel reach more people who need to hear this. Subscribe to Liana Invests for more honest, no-nonsense financial education every day, and I'll see you in the next one.